Within a 6-month window, 3.6 million Americans defaulted on their federal student loans, causing their credit scores to drop by an average of 91 points. These figures come from the Federal Reserve Bank of New York's analysis of the final quarter of 2025 and the first quarter of 2026. The delinquency rate on student debt has now climbed to 10.3%, a level comparable to the peak of the Great Recession. This spike is appearing immediately after the conclusion of the pandemic-era policies that allowed tens of millions of people to stop making payments for more than 4 years. In early 2020, the government responded to the pandemic by setting student loan interest rates to 0 and pausing all required monthly payments. Payments on these loans technically resumed in October 2023, but the Department of Education implemented a 12-month on-ramp period where missed payments were not reported to credit bureaus. Under federal law, a student loan is not officially in default until a borrower misses payments for approximately 270 days. Because on-ramp protections expired in late 2024, the required 270-day period for the first group of non-paying borrowers concluded in the fourth quarter of 2025. The on-ramp policy effectively deferred the legal consequences of non-payment, creating a 1-year gap between when the first payments were missed and when the defaults appeared on credit reports. Data from the New York Fed indicates that this wave of defaults is not being driven by the youngest cohort of borrowers. The average person in default is now nearly 39 years old, and the highest concentration of these cases is found in southern states like Georgia and Louisiana. Research into the 2019 baseline shows that 30% of these borrowers were current and actively making payments before the pandemic pause began. Another 45% were in deferment or had no payment due at that time. At an average age of 38.9 years old, these borrowers are entering default during the years they would typically be at their peak for earning income and building long-term investments. A 91-point drop on the Equifax scale moves many borrowers into near total exclusion from traditional lending. Because these records persist for 7 years, credit access will be restricted well into the 2030s. While credit scores have already been impacted, the government's most direct collection tools have not yet been deployed. When enforcement resumes, the government can seize federal tax refunds and varnish up to 7 million additional borrowers are currently in forbearance due to the winding down of the SAVE repayment plan. Following the same 270-day timeline, they face a similar risk of default once that forbearance ends. The Fed suggests this is a localized financial crisis for millions of specific households, rather than a systemic risk to the broader banking sector. Borrowers can resolve a default through loan rehabilitation, which takes 9 months but removes the default from your credit report, or consolidation, which is faster but leaves the credit history intact. Those currently in the SAVE forbearance can proactively choose a new repayment plan now to avoid an automatic default. Since active collections are currently paused, borrowers have a limited period to establish a sustainable payment plan before the government begins garnishing wages and seizing tax refunds later in 2026.